New term alert! New term alert! It's been a long time since I came up with a new term. You know, I have my terms, right? I have the cockroaches. They sell the market all the time. They're always looking for a crash. I got the zombies. The zombies totally are completely don't understand our monetary system. You know, they just are ideologically behave in a way that they do the opposite of what the true effect is for the economy or the market. Right? The zombies. I got the stop losers. Of course, they're always telling you got to use stops. You got to take losses. Losses make you rich. You got to take losses, prudent losses. Right? I got the mousy boys. What else? The what ifs. The what? Hey, what if this happens, Mike? What if the Fed hikes rates? What if this? The what ifs. So I have all these terms. I had to come up. I was thinking recently. I had to come up. There's got to be a term for the people who buy the stock market after it has gone up a long way and it continues to go up, and they just keep buying and buying and buying. And I've come up with the term the fashionistas. I'm calling these people the fashionistas because they buy because it has become fashionable to buy. Now, they weren't buying last year or any time for that matter when the market had real value and it was cheap and there was an abundance of high quality stocks that were just there for the taking, and it was low hanging fruit. In fact, not only did they not buy, they would have told you at that time to stay away from the market. It's too risky. It's going to crash. Around every corner was lurking some disaster which was about to happen, like Brexit or the election or Trump getting elected or oil prices crashing or something like that. But the fashionistas, they are partying now. They are partying like the Met Gala in the first week, the first Monday in May. Yes, they are partying big time, the fashionistas, because it has become very fashionable to buy. They hear their friends talking about the stock market. They hear their colleagues at work talking about the stock market. People in their family talking about the stock market, so they buy. It doesn't matter what the reality or the fundamentals are. The fact that, hey, economy's slowing, that doesn't matter. Fiscal flows are flat, that doesn't matter. Fed raising interest rates, that doesn't matter. And all the other things all those other things don't matter. They'll tell you that the bears have no argument whatsoever. The fashionistas are out and they are partying like it's the Met Gala at the end of March as opposed to the first Monday in May. All right. So I had to come up with that term. It's very important that I have the term, so I add that to my list of terms of market participants, and it also speaks to a certain kind of behavior. Now, I have not changed my view. Looking at the fiscal flows right now, still flat. We're up 12 billion over last year. At this time last year, we're up 48 billion over the prior year. Fiscal flows were growing at something like a little over 2%. Now they're growing at 0.8% since the beginning of the year. For me, that is a 0.8 growth rate, if we're lucky, in the first quarter of 2017. So we slowed down we had a 3.5% growth in the third quarter last year. We got 2.1%. They bumped it up today to 2.1%. Whoopee. We're going to have, that was for the fourth quarter. We're going to have 0.8% growth in the first quarter. So you got that going there. By the way, I sent out 3 emails today to MMT Trader subscribers. If you want to get those emails, go to my website, pitbulleconomics.com. And right there on the homepage, you'll see get the 30-day free trial. One was about bonds. All right. Now, a lot of you have been asking me what my outlook on bonds is. And given some of the statements made by Fed officials yesterday, these guys are very much still committed to their rate hike program. They're talking about 3, maybe 4 rate hikes this year, additional rate hikes this year. And even if that doesn't happen, the very fact that the Fed is committed to further rate hikes that limits the ability of bonds to rally. You know, bonds could rally a little bit every time maybe some data shows up weak, which it will. But the ability to have like a sustained rally, it's just not there. That can only happen when the Fed says we are done, definitively comes out and says we are done raising rates, and the next move on our part is going to be to cut rates. That's when you want to buy bonds. I mean, it's not happening. All right, it is not happening. And not only that, but the rate hikes or rate cuts, whatever the program is, that sets in motion the momentum of a sustained cycle. All right, rate hikes, I like to call them price increases. Until the Fed says it's going to lower prices, the prices keep going up. So that's going to be the trend. Anyway, I sent out that email. I sent out an email on, I think, something very interesting. You hear a lot of people very often, it's the fashionistas who will say, well, the market's going up because there's a lot of cash on the sidelines. Every time I heard that, I always wondered, like, how do these people know? And I'm sure if you ask them, they could not point to any particular, resource or body of data which shows the cash on the sidelines. But I have a way to get a sense of that, to measure that, a barometer for that, and I talk about that in my email. And there happens to be right now a lot of cash on the sidelines. And what does that implicate? What does that portend for the market? I talk about that. So you may want to get that email. Anyway, the fashionistas, folks, are you a fashionista? That is the question. Are you a fashionista? Here's the thing about fashionistas. They have their parties just a couple of times a year. Then it all goes away, all right? The same thing with the fashionistas in the stock market. You don't want to be a fashionista. You want to be an informed, intelligent, savvy investor that has really good mental game. That's what you want to be. Then you make money all the time like I do. All right, everybody. I'll see you later. Bye-bye.